Why does fiscal policy affect a nation's currency value? Have you ever wondered how government spending and taxation decisions can impact the money in your wallet? Fiscal policy plays a significant role in shaping a nation's currency value, and understanding this connection can help you navigate economic changes. Fiscal policy refers to how a government manages its spending and taxes. When a government decides to increase spending or cut taxes, it can lead to more money circulating in the economy. This often raises demand for goods and services. However, when demand increases too quickly, it can lead to higher prices, known as inflation. Inflation is a key factor that affects currency value. When inflation rises, the purchasing power of money decreases. This means that each unit of currency buys fewer goods and services than before. As a result, the value of the currency can drop compared to other currencies. For instance, if a government adopts expansionary fiscal policy, which includes increasing spending or reducing taxes, it can stimulate economic growth. But if the economy is already operating at full capacity, this increased demand can create inflationary pressures. Investors may lose confidence in the currency since the real value of their returns diminishes. This loss of confidence can lead to a decrease in demand for the currency, causing its exchange rate to fall. On the flip side, contractionary fiscal policy, which involves cutting government spending or raising taxes, can help reduce inflation. By lowering overall demand, this approach can strengthen the currency. When inflation is kept in check, the purchasing power of the currency remains stable, which can boost investor confidence. Another important aspect is how fiscal policy influences perceptions about a country's economic health. If a government runs large fiscal deficits and borrows heavily, it can raise concerns about future inflation and the ability to repay debt. These worries may prompt investors to seek safer assets, leading to currency depreciation. Fiscal policy also plays a vital role during economic shocks, such as a pandemic. In such cases, governments may implement large fiscal stimulus packages to boost demand. While this can help the economy recover, it can also contribute to inflation, affecting currency value. The relationship between fiscal policy and monetary policy is also significant. If a government is pursuing aggressive fiscal expansion, it can complicate efforts by central banks to control inflation through monetary policy. This can create challenges in maintaining a stable currency value. In practical terms, governments aiming to stabilize their currency value need to coordinate fiscal policy with monetary policy. By balancing spending and taxation, they can manage inflation effectively. This approach helps maintain the currency's purchasing power and its value in international markets. In summary, fiscal policy affects a nation's currency value primarily through its influence on inflation and economic demand. Understanding this relationship can help individuals and businesses make informed decisions in a changing economic environment.